A corporation is created by operation of law. Thus, organization costs are incurred in forming or organizing a corporation. Organization costs include legal fees, incorporation fees, and share issuance costs. According to PAS 38, paragraph 69, startup costs, which include legal and secretarial costs in establishing a legal entity, shall be recognized as expense when incurred, except with share issuance costs that are directly attributable to the issuance of new shares that shall be deducted from equity net of any related income tax benefit. Joint costs relate jointly to the concurrent listing and issuance of new shares and listing of old existing shares. Share issuance costs are direct costs to sell share capital, which normally include legal fees, CPA fees, underwriting fees, cost of printing certificates, documentary stamps, filing fees with SEC, and cost of advertising and promotion of or newspaper publication fee. Cost of listing shares include roadshow presentation, public relations consultants fees. Example of joint costs are audit and other professional advice relating to prospectus, opinion of counsel, tax opinion, fairness opinion and valuation report, prospectus design and printing. How do we account transaction costs related to share issuance cost? So share issuance cost shall be debited to share premium arising from the share issuance. If the share premium is insufficient to absorb such expenses, we can go after with the retained earnings. The cost of listing shares are not considered as cost of an equity transaction since no equity instrument has been issued. Therefore, such costs are recognized immediately and expensed when incurred. While joint costs are allocated between newly issued and listed shares and the newly listed old existing shares. For the illustration, we have a number of 60,000 shares for listing and issuance of new shares and 40,000 for the listing of old existing shares. So, we have a ratio of 60% of new shares and 40% of old existing shares. When we talk about the listing and issuance of new shares, it refers to share issuance cost. When we talk about listing of old existing shares, it refers to share listing fee. So the entity incurred the following costs. For underwriting fees, it is classified under the share issuance cost. Tax opinion, joint cost, opinion of counsel, joint cost, listing fee, share listing fee, cost of advertising and promotion, share issuance cost, other joint costs, joint cost. So the total amount for share listing fee is 55,000, share issuance cost 100,000 and joint cost 165,000. The journal entry to record the listing fee is that debit share listing fee and credit cash in the amount of 55,000. For the journal entry of share issuance cost, debit share premium and credit cash 100,000 if issued more than par. If issued at par, debit share issuance cost, credit cash 100,000. Again, the ratio of listing and issuance of new shares is 60% and the listing of old existing shares has a 40%. The amount allocated to share listing fee is 40% of 165,000. So 165,000 times 40% is equal to 66,000. and amount allocated to share issuance cost is 165,000 times 60%. Amount is 99,000. So for the journal entry to record the joint cost, we debit share listing fee 66,000, debit share premium 99,000, and credit cash 165,000. Accounting for share capital. There are two methods recognized in accounting for share capital. We have first, memorandum method, and second, journal entry method. For the first transaction, which is authorized to issue share capital, under memorandum method, only memo entry is made. Journal entry method, we debit unissued share capital, credit authorized share capital. Second transaction, receive subscription. Under memorandum method, we debit subscription receivable, credit subscribed share capital. The same entry for journal entry method. For the third transaction, collection of subscription. The same entry under memorandum method and journal entry method, which is debit cash, credit subscription receivable. Next transaction, receive full payment. The same entry for memorandum method and journal entry method, which is debit cash, credit subscription receivable. Next transaction, issuance of shares capital. Under memorandum method, we debit subscribed share capital, credit share capital. Under journal entry method, we debit subscribed share capital and credit unissued share capital. For the last transaction, which is the cash subscription, under memorandum method, we debit cash, credit share capital. Under journal entry method, we debit cash and credit unissued share capital. Issuance of share capital. Shares can be issued at discount for non-cash consideration and exchange of services. The entry to record the issuance of cash if at par, debit cash, credit ordinary share capital. If issued in excess at par, debit cash, credit ordinary share capital, and credit share premium. The entry to record the issuance of share capital at discount, we debit cash, B another debit discount on share capital and credit share capital. Remember that the discount on share capital account is a deduction from the total shareholders' equity. If shares are issued for non-cash consideration, the following entries are made. Before we record such transaction, we should consider first if there is a existing fair value of non-cash consideration received, in the absence of which we will use to record the fair value of the shares. In the absence of fair value of non-cash consideration received and the fair value of shares, we use to record the par value of the shares issued. The fair value of non-cash consideration received, or the fair value of the shares, or the par value of the shares, is used to record on the non-cash consideration or the non-cash account. In our illustration, we have the building account. Any amount in excess of the par value, we credit it always with the share premium account. In issuance of shares in exchange for services, we record using the fair value of the services or the fair value of the shares, whichever is clearly determinable. The typical journal entry we made in recording the issuance of share capital in exchange for services, we debit the expense account and credit ordinary share capital. In the case that the fair value of the services or the fair value of shares exceed the par value, we record again with the share premium account. Quartered shared would mean that the amount of consideration received is less than the amount of the share capital. In the example, we have 350,000 amount of consideration received and the amount of share capital is 500,000. Therefore, a water is created in the share capital. In this transaction, we typically record in the full amount of 500,000 which we debit